Imagine you drop an apple, right? And instead of hitting the floor, it shoots straight up and smashes into the ceiling.
Right, which would be completely terrifying.
Yeah,
Yeah.
exactly. But honestly, that is precisely what it feels like looking at the Australian property market right now. Because normally, economic gravity is pretty reliable.
Hmm.
You know, the central bank hikes interest rates, borrowing gets wildly expensive, and property markets cool down everywhere. It's supposed to be this universal rule.
Yeah, textbook economics.
Right. But looking at the stack of data on our desk today, we have a market where half the country is falling back to earth like it's supposed to, and the other half is somehow running up a down escalator.
It's a complete fracture of the traditional economic rules.
Yeah.
We're watching this real-time battle between monetary policy, so those crushing high interest rates, and physical reality.
And spoiler alert, physical reality is winning.
Winning hands down, yeah.
So, figuring out why that is happening is our mission for today's deep dive. For you listening at home, it's April 2026, and we've got a massive stack of brand new, highly authoritative reports.
Some really fascinating numbers in there.
Oh, absolutely. We're looking at fresh, granular data from Cotality, CoreLogic, the Commonwealth Bank, RSM, PropTrack, and Gemini. And our goal is to tear into these reports and understand why the Australian real estate market has violently split into this two-speed era.
Right.
Like, why are Perth and Brisbane defying all economic gravity and just soaring, while the traditional heavyweights, Sydney and Melbourne, are stalling out or even sliding backward?
Well, the short answer is that we're witnessing a powerful positive feedback loop that is just completely overpowering the central bank.
Okay, break that down for us.
Sure. So in Perth and Brisbane, you have severe structural supply shortages, and they're colliding directly with massive regional infrastructure investment plus booming population growth.
A perfect storm.
Exactly. When those three elements combine, they create an economic engine so powerful that a high cash rate simply cannot slow it down.
Okay, to really wrap our heads around this engine, we need to look at just how massive this split actually is in the March 2026 data. Because, when I first read these figures from CoreLogic, I honestly had to double-check that there wasn't a typo.
I don't blame you. The divergence is just staggering.
Yeah.
If you just glance at the national average, property prices are up 0.7% for the month.
Which translates to, what, an annualized rate of about 9.9%?
Right, 9.9%. And on paper, that sounds like a healthy, normal, booming market.
Yeah, that sounds great.
But that national average is essentially a statistical illusion. It's, masking a massive fracture.
So who's actually driving that 9.9% average up, and who's dragging it down?
Well, over the last year, Perth is up an absolutely massive 24.3%.
Wow.
Yeah. And Brisbane is right on its heels at 19%. They are surging at a pace that's frankly difficult to comprehend in this macro environment.
But then you look at Sydney.
Right. Sydney actually went backward by 0.1% for the month of March, and Melbourne dropped 0.2%.
And Melbourne's been bleeding out slowly for a while now, hasn't it?
It has. It's down 0.9% since its peak back in November 2025.
Think about that. Perth is up nearly a quarter of its value in 12 months, while Melbourne is actively losing value. That is a completely different universe.
It really is. And it comes down to the physical bottom line. We mentioned structural supply shortages earlier, right?
Yeah.
To put a number on that, Perth's current housing inventory is a shocking 48% below its 5-year average.
Almost half.
Half the normal houses available, yeah.
Yeah.
Brisbane is 31% below its historical average. There simply aren't enough physical roofs for the sheer volume of people who need them.
But hang on, I have to challenge the mechanics of this a little bit, because even if there are no houses available, a cash rate of 4.9% or higher is specifically designed to crush borrowing capacity.
Right. It makes money very expensive.
Exactly. It mathematically restricts how much money the bank is legally allowed to lend you. So if people can't borrow as much, why are buyers in Brisbane and Perth still panic bidding? Where is the actual cash coming from to drive prices up 24% if borrowing is this painful?
That's a great question, and you're hitting on a crucial shift in how we need to think about demand.
Okay.
See, what usually treat demand as something flexible. Like if prices get too high or a mortgage gets too expensive, buyers will just sit on their hands and wait it out.
Sure, you just delay buying for a year.
Right. But right now, in Western Australia and Queensland, demand is fundamentally trapped. High interest rates definitely lock out the marginal buyers at the very bottom of the market. But the sheer volume of interstate migration and local job growth in those states means the physical need for shelter cannot be deferred. You can't just put off living somewhere.
Right, because the alternative is sleeping in your car in a city where you just landed a great new job.
Precisely. When you have an absolute scarcity of physical inventory, it creates what economists call an inelastic upward price movement.
Meaning?
Basically, that means price isn't the deciding factor anymore, availability is. People aren't taking out these massive mortgages because money is cheap. They're buying because they have to.
They're just stretching themselves to the absolute limit.
Yeah, just to secure one of the few available assets.
But if these buyers are stretched to their breaking point by these high rates, they can't do this on their own. I mean, they need some kind of financial lifeline to keep bidding up these prices. Otherwise, the market would just seize up entirely.
That's exactly what's happening, yes.
And looking at the data, it seems that lifeline is coming from two very specific sources: regional economic resource cycles and absolutely brutal rental yields.
Yeah, let's focus on the resource cycle in Western Australia first, because the scale of wealth generation happening there is really unique right now.
Okay, set the scene for us.
The state is currently riding a massive resource supercycle. It's driven primarily by natural gas and iron ore, which are sitting at historically high global valuations.
Right, but how does a global iron ore price actually translate to, someone outbidding another buyer at a suburban house auction in Perth?
Well, it works like a giant funnel. This global demand isn't just generating corporate profits, it generates massive state royalties for Western Australia.
Ah, got it.
So the state government takes billions in revenue and pumps it directly back into the local economy through infrastructure and services.
Which creates jobs.
High-paying jobs.
Yeah.
So imagine a mining company suddenly needs 500 new specialized engineers. To get them to move to Perth, they have to offer, say, 20% over the national market rate.
Okay, so suddenly you have 500 highly paid professionals arriving in the city.
And they all competing for the same 50 available houses in a desirable suburb.
Wow. So the bank looks at their inflated resource sector salaries and just approves massive loans, completely bypassing the intended cooling effect of the central bank's interest rate.
Exactly. It creates a classic wage-price positive feedback loop. People are earning significantly more, so their buying power increases.
Meaning they can service much larger mortgages despite the higher rates.
Right. The local economy is basically insulated by this resource wealth.
Okay, that makes sense for the owner-occupiers who are pulling down big salaries. But if you look at the market, investors are also fiercely competing for these properties.
They are.
Why on earth is an investor voluntarily taking on a new mortgage with a massive interest rate?
This is where we see the second financial lifeline. The rental market is acting as a massive financial shock absorber for property investors.
A shock absorber, I love that framing, because when you look at the vacancy rates, it is incredibly grim for renters.
Very grim.
I mean, nationally, the rental vacancy rate is sitting at a microscopic 1.6%. And in Brisbane, the reports show properties are getting rented out in an average of just 18 days.
18 days. And because the market is that tight, landlords are able to push rents up significantly faster than inflation.
Which brings us to that wild PropTrack data.
Yes. The PropTrack Westpac data reveals something incredible. 93% of investors who are reselling right now are still turning a profit.
Wait, really? Even with rates this high?
Even with high rates, the cash flow from these skyrocketing rents is so strong that it's absorbing the pain of the high interest rates.
So the tenant is effectively paying the inflated interest bill on their behalf.
Exactly. It gives investors the confidence to hold on to their assets and even leverage up to buy more.
Okay, so Western Australia and Queensland are wearing this economic armor. They have billions in resource revenues, booming local wages, and massive rental yields padding everyone's budgets.
Yep.
But if we flip the map, it makes the situation down south look incredibly grim. What is actively dragging Victoria and New South Wales backward?
The reports define it as a triple kill trap.
Ouch.
Yeah. Sydney and Melbourne are being squeezed simultaneously by three converging forces: extreme leverage, structural oversupply, and highly punitive state taxes.
Okay, let's look at leverage first.
Well, Sydney's mortgage-to-income ratio is a crushing 31.3% right now.
Nearly a third of a household's gross income just going to keep a roof over their heads.
Right. And when interest rates rise, that leverage transforms from a tool for wealth creation into a suffocating weight.
But Melbourne has a different issue, right?
Melbourne has a completely different structural problem. Historically, Melbourne has managed population growth through massive, almost infinite greenfield expansion on its fringes.
They just keep turning paddocks into new housing estates 40 minutes out from the city.
Exactly. Which destroys the scarcity principle we talked about earlier. unlike Sydney, which is landlocked by mountains and oceans.
Or Perth, with its strict geographic constraints.
Right. Melbourne just keeps adding supply. It creates a relative oversupply of housing inventory.
But the real catalyst, the thing actively driving the market backward right now, is the tax policy, isn't it?
Oh, absolutely. The fiscal health of these states has diverged wildly, and we are seeing how aggressive government policy can instantly alter market psychology.
The tax contrast in these reports is genuinely hard to believe. Let's compare Queensland and Victoria side by side for the listener.
Okay, if you're an investor in Queensland, the land tax threshold is a very generous $734,000.
Meaning?
That means you can hold a significant amount of property, maybe a couple of apartments or a decent house, before you pay a single cent of land tax.
Okay. And in Victoria?
In Victoria, that threshold kicks in at just $50,000.
Wait, $50,000. So an investor in Brisbane gets a free pass up to nearly $750,000, while an investor in Melbourne buys a single modest townhouse and gets hit with a compounding tax bill every single year.
Every single year.
Why is Victoria doing this?
Well, it's a desperate measure to fix a balance sheet. Victoria's state debt is projected to hit an astonishing $192.6 billion by 2028-2029.
That is a staggering amount of debt.
It is. And to service the interest on that massive debt, the state government has essentially decided to shift the fiscal burden directly onto property investors through these lowered thresholds and increased levies.
And investors are voting with their wallets. I mean, I imagine an investor sitting in Melbourne looking at their spreadsheet.
It's not a pretty spreadsheet.
Right. The central bank is charging them a fortune in interest. The rental yield is lower because of that greenfield oversupply. And now the state government is handing them a massive tax bill.
You've just described the exact mechanism of capital flight. Investors are dumping their Victorian properties.
Which causes inventory to surge.
Exactly. When thousands of investors make that same calculation and list their properties simultaneously, inventory surges, which drives Melbourne property prices down even further.
And that capital doesn't just disappear.
No, it gets wired straight to the low-tax, high-growth, high-yield havens of Queensland and Western Australia.
Capital is ruthless. It just goes where it is treated best. And right now, it's not just fleeing bad taxes. It is aggressively hunting future growth, which brings us to the 2030 horizon.
This is where it gets really interesting.
Yeah, because there is a multi-billion-dollar magnet actively pulling wealth into Queensland, and it's completely public knowledge. I'm talking about the 2032 Brisbane Olympics.
The Olympic effect is going to physically reshape the entire region. The RSM report details a $15.5 billion infrastructure pipeline that is already locked in for the Games.
Locked in, meaning the money is there.
Yes. The critical detail here is that 80% of the funding for massive mega projects like the Cross River Rail and the Brisbane Metro is already secured and actively being deployed.
So this isn't speculative government promising?
No, it is concrete being poured into the ground right now.
But it's not just the new train lines that drive property values up. It's the sheer human capital required to build them, right? The data highlights a looming shortage of over 50,000 construction workers in Queensland.
Right. Just think about the mechanics of absorbing 50,000 workers into a single state economy.
It's massive.
To attract that specific labor force away from jobs in Victoria and New South Wales, infrastructure companies have to offer significantly higher wages.
And when those 50,000 high-wage earners step off the plane in Brisbane, what is the very first thing they need?
A place to sleep.
Which pours gasoline directly onto an already blazing housing shortage.
Exactly. It creates an unstoppable compounding feedback loop of demand. But, you know, the most important insight from the RSM report is actually about urban transformation.
How so?
Well, the Olympics will force Brisbane to transition from a sprawling city of detached suburbs into a high-density, compact metropolis. Currently, freestanding houses make up roughly 60% of Brisbane's housing stock. By the time this Olympic transformation hits its stride, that number is projected to drop to just 46%.
Stop right there, because this is the real aha moment in the data for you listening. If freestanding houses are dropping from 60% of the market down to 46%, that means the actual physical dirt sitting underneath existing homes close to the city center is about to become incredibly rare.
It becomes structurally scarce. The city will have to rezone and build upward with apartments and townhouses to accommodate the population density.
And in real estate, structural scarcity is the ultimate driver of value.
Without a doubt.
So if you are looking at your own portfolio or trying to figure out how to navigate this fractured market, how do you actually apply this knowledge?
The reports outline a very clear asset allocation strategy. Investors need to aggressively target affordable, mid-inner ringland assets in Brisbane and Perth.
Just because of that density shift.
Because of the density shift and the extreme scarcity of inventory, these specific assets, freestanding houses on decent blocks of land, relatively close to the CBD, offer the absolute best long-term investment alpha.
Alpha, just to translate for anyone not steeped in finance jargon every day, meaning the kind of return on investment that actively beats the market average, rather than just coasting along with it.
Exactly. Because you are buying the very thing that the city is running out of. They have the highest growth ceiling of any asset class in the country right now.
And the contrast with Melbourne right now is terrifying. I want you to share that projection from the Gemini Deep research because when I saw it, it completely broke my mental model of Australian real estate.
It's a profound forecast. Gemini projects that by 2030, a freestanding house in Melbourne could actually be 30% to 50% cheaper than a comparable house in Brisbane.
Wait, 30 to 50% cheaper? That completely upends over a century of Australian real estate hierarchy.
It really does.
It tells us that anyone looking at Melbourne right now and thinking, look at all these price drops, it's a cheap bargain, I should buy the dip, is walking into a trap.
It is the crucial difference between a temporary cyclical dip and a permanent structural decline. The holding costs in Victoria are simply too high, and the economic growth drivers just aren't there to justify the leverage.
So Melbourne is just stuck.
Melbourne is facing structural stagnation, while Brisbane and Perth are in a prolonged phase of structural elevation.
We have to be objective, though, because no market goes up in a straight line forever. What are the storm clouds here? If someone buys into this Brisbane or Perth strategy today, what risks could blow this up?
There are always macro threats to manage, of course. In the short term, if the central bank surprises everyone with unexpected aggressive interest rate hikes, or if the federal government steps in and radically alters capital gains tax policies,
We'd see a reaction.
yeah, we will see immediate volatility and hesitation across every market.
But wouldn't the rental yields in WA and Queensland kind of absorb that?
They absolutely provide a massive buffer. Because of the low state land taxes and the incredibly high rental cash flow, investors in those states can weather national headwinds far better than anyone else.
Okay, so what's the real threat then?
The actual systemic warning sign for a real cooling period in Perth and Brisbane won't arrive until much closer to 2030.
What happens in 2030?
That is when the massive Olympic infrastructure supply, the actual construction of new homes, will finally start to catch up to the elevated demand.
So when the cranes stop moving and the inventory normalizes, the engine slows down.
Precisely.
So it's not a catastrophic crash, just a loss of momentum.
Correct. We expect a gentle deceleration in growth. The data strongly suggests the ideal window to sell and maximize returns on these mid-ring assets is between 2029 and 2031.
Just before that transition from scarcity to balance occurs.
Exactly right.
If we pull all of this together, it perfectly answers the mystery we started with. If high interest rates are the central bank stomping on the economic brake pedal, then massive structural supply shortages, billions in resource wages, and an Olympic infrastructure pipeline are a V8 engine.
And right now, the engine in Perth and Brisbane is easily overpowering the brakes.
It really forces you to step back and look at the map differently. We've spent well over a century viewing Sydney and Melbourne as the untouchable default financial and cultural centers of Australia. They were the undisputed kings of the hill.
They were.
But if the physical wealth generation, the massive infrastructure spending, and the actively migrating populations are all permanently shifting to the resource and sunshine capitals.
It begs the question. Are we witnessing the end of Australia's traditional economic hierarchy forever?
That is massive thought to chew on, a permanent changing of the guard. Thank you for joining us on this deep dive. Keep looking at the data, keep questioning the consensus, and we'll catch you next time.